Hey, it's Arthur here, and in this video I'm going to talk about bank funding in 2026. So if you're a founder based in the EU and you're considering raising money from banks, or you have current existing loan in one of the banks, this video is for you. So we have analyzed 2025 in terms of what's happening with the banks, are they growing, going down, what about the rates, and I can say that it's getting cheaper, but it's getting tougher to get money from the banks, and you need to become smarter this year. Okay. So before going further, my name is Arthur Geisari. I'm founder of Offerta Finance. It's a brokerage company based from Latvia, and we're helping entrepreneurs and founders around Europe to raise money. Briefly about me. So I was working in Ernst & Young as an auditor. Then I quit and started my career in employment. In 5 years' time, I got to my CFO, and then I quit and started my lending companies and different wholesale retail businesses. So in total, I have like 36 different companies. Then I experienced my first bankruptcy, divorce. Then I recovered, launched my brokerage company, and then I'm giving back in terms of the seminars, webinars, and the free YouTube video I'm doing for you guys. And so in total, I have 5 years experience in financial industry, 10 years experience in entrepreneurship, 36 different launched companies. In total, 100 million euros fundraised successfully for SMEs around Europe. And this gives me a lot of patterns and statistics, what works, what doesn't work. And this is the prism through which I'm sharing all the information for you guys. So the agenda for today, we have 5 topics. One, what about the rates? Are they going down, going up? What has happened in 2025? What to expect in 2026? Second, about the competition. What's happening with the banks? Are they competing more or competing less? Should I be worried? Then we're going to talk about alternative lender, because there are some alternatives to the bank financing. Then about the volumes of the lending. Are the outstanding loan portfolios of the banks going up and down? And what does it mean for us as founders? And finally, what about the standards? Are they changing? And if yes, by how much standard they're changing in your country? Okay. So what about the interest rate and the Euribor? So first, if you look at the Euribor for the past 2 years, it's declining. So it's 2.1% decline over the last 2 years, and only 2025 it has decreased by 0.7%. It means that the banks are borrowing at a cheaper rate between each one of them. Then if you go to the business rates, by which interest rates the business is borrowing from banks, we can see a clear downward going trend. It's across all the Europe, so we have analyzed all the European banks and for the last 20 years. So you can see for the past few years, it has been going down to the average up to, I think, 3.5%. This is the average borrowing rate for SMEs from the banks. So there's a decline. Then if we take a look at the source of funds for the banks, because some say, Euribor is going down, it means my rate should go down. No, it doesn't mean like that. So we need to analyze and think how banks are thinking. And you can see this is the average typical structure of the banks, or where they get their money from. And mostly they get from deposits. So customers pay money to get the interest rate. This is the estimated cost of that, right? So given all this, the Euribor bears only 10% of the total typical share of funding, but still it's tied, because in most of the loan agreements between the SME and the bank, there's a rate plus Euribor together. So what does it mean for us? It means that if the rate is going down, it means we can do something about it. So first, what we need to do is to refinance a loan. So right now you can call your bank and say, hey, I have this old loan agreement, it's tied to this rate, I want to reassess my interest rate. Even though it's tied to Euribor, it's fixed plus Euribor, you can still renegotiate, because the total borrowing cost for bank is going down. This means that the bank has more possibilities for you to rethink. If your bank is rejecting you, they can go to the neighborhood bank, and that bank will lend you money. So this is one thing we can do as founders. Second, what we need to do, we can be careful about what means Euribor narrative. Euribor just means the banks, I think they come up once a month or something like that, and then they think about, okay, at what, or once a day, by which rate you can, I will lend you my money and this bank will lend me money. So they take all the average pool of all the rates and they sum up and they have this average, right? So be careful, it's not the direct lending rate, and it constitutes only 10%. So it can work both ways. So if a bank says, we are tied to Euribor, that means that either the manager is not understanding it correctly, lying to you. Either way, the more information you know, the better for you. The third one, banks are funding at 2-3%, And if you still borrow at 5, it means either your risk profile is higher or you need to rethink your narrative. You need to clean up your financials and do the homework. This is what we teach in the seminars, webinars, and the workshops. You need to do the homework in order to be properly prepared to fundraise money. Okay, next. So what about the competition in the banking sector? What's happening there? Well, first, the number of credit institutions is declining. So 5,000 banks are left in the European Union and is going down. And if you think in your country it's different, no. If we see the other countries, but we'll go there in a second, it's an average 1% per year. We're losing 1% of banks every year. So 56 banks we lose per year. And furthermore, banks are closing their branches in the longer areas of the country. It means that if before you had this possibility to go to your local branch, have a local manager, and the local manager has this local partial decision power on the credit committee on your loan, now it's more centralized and you don't have that personal connection anymore. So it's declining, and we have the tendency, and it's going even more with all AI and automation and seamless onboardings and online services. It's becoming less and less common for banks to have the branches around the country. So if you took a look at the countries, in each country, number of banks is getting lower and lower. We will see later in the slides what does it mean for us as founders, because there's another question. If there's less banks, it doesn't mean there are less loans in the market, or it doesn't mean the competition is getting worse or better for us. But still, this slide shows that the banks want to earn their return on equity. It doesn't matter what happens on the market, what happens with number of banks. Banks want to earn money, and this slide proves it all. In all the countries across all the European Union, banks are earning pretty decent returns on equity. Look at that one. Look at the Hungary, almost 20% return on equity, higher than the I think average industries. Cyprus, Latvia, the country I'm from, 17.2%. Lithuania, it's even bigger. Okay, maybe France 6.6, Denmark 12. Still, Denmark actually is one of the highest borrowing countries. They have the highest loan to GDP ratio. So they're very crazy. They know how to borrow to grow the company. This is the main point of all the topics I'm speaking about in YouTube and the LinkedIn, is that you can use the money from banks to grow your company. This is the main idea behind everything. You can use your own money, you can use your customers' money, you can raise equity and investors, or you can take money from banks and use that as liquidity to grow your company. So this slide shows banks were there and they want to earn money. They're doing that. They're pretty good at doing that. And there's none of the countries when it's negative. Maybe there's some banks who are doing not bad and then they're out of the business. They're being bought, consolidated, or ripped off. But banks know how to earn money and they'll continue doing that. Then, of course, in some years they have lost it. In terms of the percentage, when the crisis 2008, we can see what happened when the return on equity, the banks were losing money on average, but now it's getting higher and higher. Look at the last 10 years, they're just increasing. So banks getting more efficient on using their own funds, using the money from the customers to earn more money. And we'll see in the later slides what's with their credit policy, like what has an impact on this one. So key takeaways for us as founders. First, we're losing banks. Yeah, we can cry here. It's a tougher competition. It means that we less banks per se, per capita, per SME, per founder out there. It means you have less options to apply to. Of course, some banks maybe go international. They open up their branches in different countries, but still it'll be much tougher for you as a founder to get money because there'll be less and less banks. And less banks means they have less competition. And less competition for banks means tougher competition for us, for you and for me as founders to get money from banks. So it means we cannot have a general pitch overall. We need to tailor-made or request for a specific bank we're working with. This is number one. Number two, there'll be no local decisions because of the branches. It'll be harder to pitch. It means that your numbers need to be precise, concise, prepared, all the data room ready out there to be able to borrow from the banks. And as there are bigger banks, so smaller banks are consolidating, the banks are getting bigger, because you will see later on that the volume of the money in the banking system is actually getting higher. It means the banks are getting bigger. So you need to stop behaving as a 1-year-old or as a startup founder without any information. Be prepared, know the rules of the game of the banks. So prepare your structure, prepare your documents, know what is EBITDA, what is debt service coverage ratio, what is loan to value, like learn all these things. Show the exit logic, how you will make the repayments. Because always remember, when the bank is assessing any company out there, any founder, first question, what's the founder? Like, is there something bad about the founder or the previous negative experience? Second, what's the revenue? From like the revenue, we can say debt service coverage ratio, right? EBITDA, debt service coverage ratio. So is this company capable of paying back the money from the loan that we can give the money? You can take 10 to 30% of your annual revenue, and that could be an average amount a bank could lend you, but still they need to make sure that the payback is right. And third aspect is assets. Other assets we can take as collaterals. We will see in the later slides that this is not changing. Actually, in the last 5 years, they have made sure they need more assets to put a pledge on, to have as a collateral in order to lend the money. So they're not easing up the game. They're making it harder. They need more assets. Why? Because banks are not taking the first risk. You as an owner, other investors who are on the cap table, they're taking the first risk. Banks are not. So banks want to have like the safest asset possible out there, right? So these are 3 things they care about, and then there are other 20. So be prepared. This is the main key takeaway here. Okay, what about the alternative lending? Well, in this one, we made the research, and unfortunately, they're still lagging behind the banking sector. So there's not many graphs and research we can show to you. Just from my experience, I can say that they're emerging. For past 10 years, they have emerged a lot of SME lending companies. I just by myself founded 3 of them. We had a crowdfunding platform and SME lending companies. And the number of companies is increasing, but it's still relatively very small amount. They called alternative lenders. In every country you can find association of alternative lenders. You can go to the website and check what kind of company they have. And then they fund farmers, they fund manufacturers. Usually it's double digit. It's more unconventional loans, and it's more kind of invoice financing, factoring. There could be credit line. It could be revenue-based financing for SaaS-based startups. So getting more and more, but there's no one graph I can show to you because it's just new industry, right? It's not that much kind of regular. It's small. It's relatively like 0.something% of the total lending volume, but still it's there and helps for the companies to grow, right? So first, it's not alternative anymore. It's getting more and more. There's more and more information. For example, in Denmark, there's this company called QRed, and they're working in other Scandinavian countries. You can borrow money without any collateral there, and there are many situations like this. So you just need to Google and look for that. So non-bankers, they didn't just show up; they scaled up, and the hard numbers, right? So 28 billion in direct lending, and it's growing. So 2025 is growing for alternative lenders. Year-to-date, direct lending grew, and the private credit now, they're growing. So we can say there's more and more. You can issue bonds. You can if the bank is rejecting you, can go issue bonds. So go to your local bank, usually they're the bond issuer, and talk to them. Talk to your private banker. They can help you to go that road. Or you can choose the alternative lending, non-bank alternative on collateralized loans, for example. So they're there, and this is what I can say. So don't default to banks. Always have a plan B in terms of the alternative lenders you're applying. So it means have dual file. They don't care that much as banks about, let's say, DSCR or EBITDA numbers. They care more of other factors, right? And use that as a speed. They're much quicker. Like we work with different partners in different countries and with different banks and non-banks. Non-banks are quicker. Non-banks can give me money in 2 days. Banks most never do that. They just check your bank accounts and QYC and AML in 2 weeks. From alternatives, we can get money in 2 weeks. So this is the main difference. Okay, then we go to the lending volume. So what about the lending volume? Is it going up, going down? We can see that so this is the outstanding value of just the loans. So we can see it's going up, going down, but mostly it's growing. So the demand for loans is growing, and the outstanding loan books are a little bit growing. So in general, it's getting better and better. So it slightly rose in this report. We see it slightly rose by 2%. Another report, we see that the demand has rose. The amount of money lent, like the loans lent in 2025, has grown, but the outstanding is not changing. So this report shows outstanding is not changing, it's sitting not there. So it depends on what kind of report you read. You can say that in general, the loan books are not growing. And even though you can see the economy is growing, so EU nominal GDP is going up, still the loan to GDP ratio is going down. It means the economy is growing much quicker than the money that the banks can lend and are lending to a business over there. So what does it mean? It means that if the economy is growing, it does not mean that banks would start lending you more money. If you read in the newspaper that GDP goes up in my country, it doesn't mean nothing, right? It just means that a number is growing up. Doesn't mean you have a better interest rate? No. So also, you can assume the capital is limited. So banks are ready to lend, but they are asking more questions. So what you can do, you can position yourself as a multiplier. It means when you go for money to a bank, you need to frame your ask and show that by borrowing this money, you will make decent jobs, you'll pay more taxes, the economy will be better off. So you need to have a secondary positive impact from your business, from your loan to an economy. And then you can use this graph to see that actually you need to spend more money on your homework and preparing your company to raise money from banks. Since there are less banks and they are not increasing their loan books, we need to spend more time on getting the money from the banks. Okay, so what about the standards? What's happening there? So this is a graph that shows that for the enterprises, the credit standards on average have been changed by 4% of the total banks in the euro area. So this number 4 in this shows that 4% of all EU banks have tightened their credit standards. 4% of, so every 400 banks have done that. And they also have seen that the demand has rose for the enterprise loan by 2%. So we can interpret that founders, on average by 2% in 2025, they needed more money. More and more new companies are going to the liquidity market and borrowing money from banks. But 4% of the banks are tightening up their credit policies. And the reason for that is the perception of risk. So the competition is not changing. The cost of funds in this report saying it's not changing, even though we see that the cost of funds is going down because of Euribor, etc. But the main factor driving that is the perception of risk. So bank sees the geopolitical, political, financial risks, and they incorporate those risks in their scoring model, and therefore they tighten up the criteria and they have higher rejection rates. Why? Because they perceive the risk. It's not about your specific company in general. Don't get me wrong. We as founders, we like to think that it's because of my numbers, because of my company. No, it's because of the geopolitics, of the politics of the country, of the industries in general, of the banking sector in general. How do they perceive the total risk? And then if you happen to be in that industry, well, bad for you. And one could see for the past few quarters, what do banks have changed? So let me explain you this graph. So these are the things that banks could have been changing. They change lending rates, go up, go down. They change margins on the riskier loans. They change collateral requirements, other terms and conditions and other factors. So by plus, it means they have changed it. Better for them, worse for borrowers. This has changed better for borrowers, so they have decreased it. So we can say that for the past, these 3 quarters, banks have made it. They need more collaterals for the loan. They need to provide more assets to use a collateral to give you money. So it didn't change. Here they're just changing the lending rates. You can see that they are decreasing the lending rates, they're decreasing the margins on average loans, but they are not changing the collateral. It means if you're thinking that next time you'll have a better LTV, no, it's not true. Next time you will have maybe a lower interest rate, but not LTVs. Okay, so what next? Next we can take a look at the rejection rates. So we can see that the rejection rates are going up. Banks are rejecting more and more entrepreneurs and SMEs and founders across Europe in the past quarters. We can say for the last 2 years they're rejecting even more. But in 2025, it's still there. So they're rejecting you more, it's getting more and more harder to get loans. So what is the key takeaway? So first, know your playbook. Know the playbook of the banks because they're tightening their credit policies. How to do that? You can ask a bank. What are the top 5 criteria you're assessing for this type of company that I do? It's for free. You can call any bank and ask that questions and they will shoot you out with their answers. No problems for that. And then you just understand how they calculate, how they think, what's their mindset, and you use that to your leverage. Second, you give the risks teams reasons to say yes, right? So since rejection rates are going up, it's getting more and more harder. It means you need to have clear structure, clear visibility. Like I just remember this week case, we have a founder, he has a collateral around 1 million valuation. He needs 500,000. Everything is fine, totally good, but the use of funds is okay, even though it's questionable, but still okay. But the goal for the funding is not clear. So we just had a meeting yesterday with 2 days ago with a funding company. It's alternative lender who's giving the money, and they say we want to give, but we don't understand what's the purpose of the loan. And remember, the regulation of all the banking sector requires for bank to assess the validity of the objection because the anti-money laundering laws and etc. So bank needs to make sure that they understand where the money will be coming to. Even though it's my collateral, my company, I have 1 million valuation, I need 500,000, still they ask question where the money will be coming to, what I will buy, what kind of project. And this customer says something about they need to develop kind of project in Switzerland, they have no business plan, no understanding. So the manager of this company, of the lending company, he read between the lines and he said, well, if there's no exact description where the money will be coming to, what's the kind of project, what's the business plan, they will reject the loan. So we'll see how it goes. So it just says that make your structure clear and know how banks are thinking. And then again, you can treat a bank as an audit. You can call the banker and ask a few questions and then treat the lending process as audit of your company. So since interest rates are decreasing, it's logically to assume the banks will have more criteria. There'll be more, more checking your account, asking more questions, and looking for the red flags. So you need to have more structure, more credible, and more approval line. So what's the general conclusion of all 5 topics we covered today? So in 2025, we can say that the rates are going down by 0.7%, and the average borrowing rate for all SMEs in Europe is 3.5%. So it means that if you have 5%, there's a reason for that, and maybe it's time to go and refinance your loan. Second, number of banks is going down every year for the past 15 years, and it will continue to be done like that. So it's tougher competition for us to get money because less banks, same amount of customers applying. Third, alternative lenders are on the rise, so every time you consider a bank, also consider an alternative lender. Then 4% of banks tighten their credit policies. It means for us it'll be harder to get money from banks. They'll ask more questions and they expect from us more clarity on our homework, on our preparation for the loan. Rejections are going up. Banks are stricter on the credit policies and they reject more loans. And loan demand is increasing by 2%. Well, while outstanding, to our understanding, to our vision, is not changing. It means less banks, but the same amount of liquidity in the market. And the economy grows quicker than the loans. It means European is still lagging behind if we compare to US to other markets. Entrepreneurs are kind of scary, they don't know. Here I can share you a few patterns I see from the founders all around Europe. So first, founders, they don't know how to raise money from banks. They just don't know the process, the procedure. Why? They're afraid of getting no. They're afraid that if they don't know, they apply, there'll be something wrong. And because they're afraid, they are not willing to understand how the process works. It costs you nothing to call a few banks and ask how it works. What's the procedure? It costs you nothing to watch my YouTube channel or use ChatGPT or any of the other sources, or call your friends who are working in a bank, or call your friends entrepreneurs and ask how does it work. But the pattern is the same. Founders, they don't know how to raise money, they don't want, they're afraid of doing that. So for them it's either bootstrapping or raising equity from VCs and another type of VC funds. So this is the choice, of course, but raising equity, you give up shares. By raising debt, you give up 0 shares. So the patterns are clear, and for me, as a founder of myself, I fully understand that, I get it, but still, there's something we can do about that. So before thinking what we can do, we need to know what our partners are thinking. So what's the view of the bank of all this situation for 2025? So banks are thinking we're making 0.7 less on new loans as before. So what does it mean? It means we will not call the existing customers and offer them a lower rate. No way, we need to earn money. Remember the return on equity increase of the banking? No, we don't do that. So don't expect a bank to call you and say, hey, you have this 2% plus Euribor rate in your loan agreement. Do you want to have a better one? No. Either competitors will call you and offer that to migrate from one bank to another, or nobody will call you. Or I will call you and say, hey, you're paying too much. Nobody will call you. Nobody will save your ass. Sorry for that. It's life. Second, how the bank thinks. Competition decrease. The amount of liquidity stayed the same. The amount of SMEs stayed the same. So the customers stayed the same. We need to spend less money on marketing. They'll just go to us. So by having more supply of customers, we can make them harder to get money because we have more people coming in. So let's reject more. Let's have better quality. Since other banks are decreasing their interest rates, we also need to decrease the interest rate, but we want to keep the quality. So we change our credit policy, make it more harder to get money. So we reject more, right? What we do next, since the bigger demand, so we either increase prices or make a policy tighter. So we choose to make a policy tighter when in the first instance it'll be possible to increase the prices. Trust me as a bank, I will increase prices to you as a founder. Sorry, just business. And since it's to keep the quality, we reject more customers. So this is how a bank is looking. Remember, bank is a commercial organization. They're registered. They have shareholders, board, employees there, and they all want to make money. Yes, they want to make a world better place, but remember that the banks are there for 4,000 years. They were before us, before dinosaurs, before the God created universe on this planet. Banks were there, and they'll still be there for thousand years. Look at their return on equity numbers. They know how to make money because they're not risking and not taking the first risk as we as founders and equity holders are doing. So banks know something what to do with their business, and if you want to get smarter, just try to get understanding how banks are thinking. So what are the takeaways for us? So first, rates are going down, but banks will not be calling you and offering you a lower rates. There'll be fewer banks in your market. We can see across all the countries. It means that less people will be calling you because there are less banks, and banks will be more selective. So it requires being more proactive from us, from founders, on approaching the banks. And then the private credit is rising, but they're still lagging behind because they're very small to compare to the banks, but still they are there. So let's explore the lane of that. And SME lending is staying the same. So it's staying flat, it's not growing in the total lending volume, so you need to stand out with the better papers, better annual reports, no tax debts, better cap tables, better asset qualities, and etc. And if the cost is going down, it doesn't mean that it'll be much easier to get loan. Actually, it's vice versa. Cost is going down, the approval is much harder. It means you need to work on your structure. So what to do? The final slide here. So what to do with this in 2026? First, you need to have your bank file ready. Prepare your materials. We teach that in workshops. We have an online webinar. We have actually one of those partly free in YouTube. We have a lot of materials on that. We have books, ebooks, or you can sit down with your accountant, with your CFO, grab some smart people from your university, from your friends, and say, hey, I want to be prepared to raise money from banks. So just start preparing your numbers, start preparing your case. Start to have your annual reports in one place. Plan your cash flow in Excel for next 3-5 years. Write a small business plan, prepare all the numbers, prepare your case. Clean up your cap table, clean up your legal issues, clean up your taxes, clean up everything. Prepare your company to raise money from banks. And yes, it takes time. And yes, nobody wants to do that. Nobody likes to do the homework. Why? Because it sucks. But it's the only way to go further in 2026. Why? Because there's less banks and they're rejecting more. Okay, next. You need to frame your ask as a lender logic. It means you need to not only prepare your files, and then when a banker asks you what's your debt service coverage ratio, what's your collateral, you sit like this and what's that? No, you know the numbers. You know what means collateral, asset, balance sheet, equity, debt equity ratio, debt service coverage ratio, what's your EBITDA, what's your gross margin, net margin, what's your unit economics. You need to be clear on your current state, on your point A. You need to define your point B, where you want to go. So how much money do you need? Where you will be spending the money? What's the use of funds? And then there's a strategy and tactics, how you will achieve your goal. There's a cash flow, there's a plan. In 1 year time, I'll build this extra production line. I'll build another factory. Then we will set up, we will launch it in second year. And then from the start of third year, we'll have increase in revenue, increase in margins, we'll have profit flowing in. Therefore, we need a loan for 7 years with 2 years grace and 5 years tenure, even better, 15 years. So you prepare your case. It takes time to prepare. It's not like overnight. From my experience, it could take from 1 month to 3 months to preparing your case, because it will be more probability of getting the money. And remember, there's only one first time when you can really apply to a bank. Because if you apply and make some mistakes, say something stupid and not fully prepared, you need to go back home, remake everything, prepare again, state your case better, spend again time, and then you come back. But second time, it will be harder because they will remember you. If you did something good, you have better numbers, even if your company is like growing up, then you have more probability of raising the money. Third, you need to open more doors. Since number of banks are going down, you need to really go and apply to all the banks. Make a competition. This is we as brokers are doing. So what's our main job? How we earn money? We take a founder, we analyze, and then we apply to all financial institutions. By doing that, we can get higher loan amounts, better terms, better interest rates, and better terms in general. And founder knows that it's the best offer on the market, and he now has a choice, or she. 5 terms, 5 offers, I choose from this or I choose from this, and then we can talk about that. So it's a question from which bank I want to have the money. Either, this bank gives me money, I need to take the loan, otherwise I have no options. So multiple options is always good when you compare it, including also the non-bank lenders in your country. You can also check the cross one. So this is as we as brokers are doing. So look guys, even if you don't work with a broker, you still can do that on your own. It will take you more months of preparing, doing that and learning that. Then I have a question to you. Are you a founder, entrepreneur who's learning financials, or your main competitive advantage is growing your business, and then you can outsource that. So you can outsource that to your accountant if the accountant is smart enough, has time, or a CFO, a fractional CFO, or you can look to advisors or brokers in your country who do that. Just give the job to professionals, so let them handle. The only thing, when you give that job, make sure that they will cover all the financial institutions that properly for you. Because they're also lazy, they don't want to spend much time, they can apply only to 3 financial institutions and give you 1 offer. No, make sure that when you talk to them, one of the topics you're talking about is to how many financial institutions we will apply. Can we have a list? Can we check them? Can we make a pre-scoring of the banks and understand to this yes, to this no, yes, no, yes, yes, yes? Then you have a list of those, and it increases the probability of getting offers from them. Because the more banks you have, the better it is for you. Remember that. Then you need to have less risk on your balance sheet. It's about the storytelling, so make it easy. So prepare your homework, make your story, make your case, state your case, and put it in the files very nicely, and make sure that the manager receiving the documents from you, manager reads that, says, yeah, that's a good case, let's go to a credit committee. So you need to decrease the risks. And you need to moving fast, because again, every year we're losing banks, and to continue doing like that, and we don't know what happened with the economy, but it seems that liquidity is getting behind the economy growth in the EU market at least. So the first come first served. This is what we see now. For example, on the date of publishing this video on YouTube is January 2026. It's the perfect time to apply for banks. Why? Because it's new year, they have new plans, they wanna fill up the quotas, fill up the quarters, have the bonuses, because all the managers have fixed payroll, plus they have bonuses from the loans they issue. They have the plans, and they're hungry after New Year's and Christmas celebrations, because it changes actually in December. In December is the worst time to apply for loans, because banks are busy with finish up all the credit committees, all the existing deals on the table. This is first, and second, you see the numbers. Most of the banks are filled up. They fill the quotas. Like I have this one bank, and the woman general manager of a bank. We have very good relationships. And she said to me, I think in October last year, 2025, she said, Arthur, we already filled our quotas. So we had this amount we need to lend, have a portfolio in 2025. It's 3 quarters. We already did it. So we reached the KPI, and last quarter will be chill. And it's good that she said that to me. She said, we will be not that quick as before, because we reached everything. Shareholders are happy, boards are happy. The same here. So you need to move first. January, you move. February, move. August, worst time to apply to bank. Because August, all the banks, all the Europe is going crazy in vacation. So it's not a very good time. So you need to time your applications correctly. So what's next? In order for you to understand how it works, how to prepare a company to apply to banks, we have prepared a lot of materials. It's on a website. Some of them are free, some of them you need to pay money. So we have different things for different flavor, from different countries. So we have Ultimate Bank Funding Blueprint. You can just download it and use it to prepare your company to apply for banks. You can watch our webinars. You can watch recordings from workshops we had with the founders last year, when we went through their company and they understood what kind of things they need to improve in their company, how to set up the case, how to set up the files, how to make calculations, how to understand where to apply, how to apply to banks. So all that information is wrapped in different products for you, so you can be quicker. By working with us, you can have less time spent on doing that and have more certainty and clarity on how to raise money from banks. Because remember, your own money is the most expensive one. Thank you very much for watching this video. My name is Arthur, and have a nice day and stay funded.